Yeah.
Hi, everybody. Thank you for coming and listening. I'm Raymond Ward, and I've got my brother John on again.
Hello, everyone. Hello, Raymond.
Hi, John. Yeah, it's been great. Fun having our discussions because, being in the same business, we uh, think along the same lines. And even before getting into this business, we thought along the same lines a lot. Uh,
Yeah.
anyway, we were talking about. Well, let me ask you, how do you recall the conversation starting uh the other day when we were just chatting about this?
Well, we were kind of brainstorming on ideas of what to talk about, and but then again, we just start talking, and then we go, oh, maybe that's a good way to,
Yeah.
it's the what true costs are, you know, and so we got into, buying a house and
Yeah.
what's the true cost, right? Of
Yeah.
what's all the interest that you're paying, and then we even went into which we will today. If you're putting 20% down so you can get away from private mortgage insurance, um, that 20% is not making any money for you anymore unless you can tap it right away, but then again, you can only get 80% of that maybe loan to value. So if you had that equity, all you've got is 80. So they probably won't even lend you any money. So it's sitting there doing nothing for you.
Yeah.
And then, yeah,
The way I was thinking about it too was that I think the thing that uh, spurred me to get into this conversation was that I was working on my new website, and I was writing up a short little explanation about this subject, but I was using cars, um, automobiles, which it works the same way. They're just not as big in numbers as if you're going to go out and get a mortgage. And that's how I remember now that yeah, I've been working on this new website, and it's a really great exercise because it makes me have to really think about it. And I want to say right here that this is really a thinking exercise, um, to slow down enough. Oh, there's Mr. Bobcat. Um, to slow down enough to really think about the math of it all
yeah,
is, and when you're
yeah,
talking about the larger numbers in a mortgage, it's mind blowing. It's almost like you'd say, how can this possibly be true? Why wouldn't everybody be doing this if it was true? Well, because we don't think of it like this. We don't think about it. Nobody's ever explained it to us. So anyway,
yeah.
sorry
We haven't
to
been
interrupt.
programmed. We've been programmed to think differently, really, is what it comes down to. And
Yeah.
run, 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 and chase the ball. Wherever that ball, they're moving the ball, and they're telling us that this is the way to invest. This is the way to grow your money. Um, and so, because this really um, cuts into their game, this becoming your own banker cuts into the banking institutions, the Wall Street machine. Uh, they're obviously not going to, they're not going to tout it. And that's most of the touting that's going on is from that marketing machine that's
Yeah, the
coming.
billions
And
of
I
dollars that they
such an
invest.
all-encompassing marketing machine, but
Yeah.
it's all geared towards doing what they want you to do.
Yeah. Yeah.
With under the guise that they're doing a favor to you, right? Because hey, we're taking care of you for your future, and
Yeah. Here's your home loan, you know.
yeah,
Here's your home loan that we're the giving you. And I want to say right here too is that there's a lot of fine people, great people in the banking industry. There's no doubt about that. It's the banking function about how it really works is what I
sure,
think that we're really bringing out. And if you
that's true.
decide that you still want to take a mortgage with a bank after this, or a car, just start off even with a car,
Yeah,
then that's your choice. But this,
Yeah.
I don't want to say, I don't want anybody to walk away thinking that we're against bankers, the person. Um,
Yeah.
it isn't about, it's about you're having a choice and understanding why you might make one or the other. Um, so anyway, sorry to
Yeah.
interrupt.
No, it's the persona. It's not the individual person and their soul or that
Yeah,
kind of stuff.
right.
Uh, no, it's what role they're playing in the play, as Nelson would say, right? What's
Yes.
their role? And their role is sometimes maybe not even a thinking game for them. They're just saying, "Hey, this is my job. This is what I'm supposed to do to generate revenue."
Yep.
And I was trained this way and taught this way, and even they're not taught any other way that would be outside an outside benefit for others, right? Like the
Yeah.
benefit ultimately is for the business. Banks are businesses,
Yeah.
obviously.
They're
So
profitable business, and there's still people that get together and go through that whole process of starting a traditional bank, brick and mortar, or whatever you want to call it. That
yeah,
they still are doing this. They're starting new banks all the time. Other banks fail, and then they try to start another one. Why do they start another one? Because it's
yeah,
extremely profitable. And
yeah,
we're just here just to say that, well, you could do it this way, and like we have learned that it takes years to get a charter to start a new bank, and
yeah,
lots and lots of money. So there's a huge investment. What we're here to say is also about this is that you don't have to have millions and millions of dollars to start this. It can be for anybody, really. Anybody that wants to be disciplined in
yeah. I mean,
their
this is
lifestyle.
totally. I'm sorry. What was that?
No, and their lifestyle too. It's about our lifestyle. Once we have a trinket, like air conditioning in our cars, then everybody has to have it now. Like before, when you and I grew up, I remember riding around in that Brookwood, bringing windows down, arms out the window. That was
Yeah,
your air conditioning.
yeah. I love those little triangle windows we had that were just a tiny window, and you could angle that just such a way that it would be blowing the wind right on your face. So when it was
Yeah,
hot, that was your air conditioning.
yeah. So
Um, you know, it's so easy to talk with you, obviously, and it's so easy to just go from one tangent to another. But I think about back to you saying what the costs are to start a commercial bank. And then the analogy is, hey, you can start up your own banking system, become your own banker, uh, and that all this infrastructure is already built in. You just plug into it, which is very similar to the idea of franchises, right? Like whether
yeah,
it be a Dunkin' Donuts, McDonald's, Quiznos, any number of things, including even the idea of network marketing, um, where you're plugging into a company's system and you become part of the sales organization, right?
yeah,
And then you can build your own sales organization off of that. So I do think of these specially designed permanent whole life policies is similar to a franchise in that they've already set the whole infrastructure for you. They have the back office, they have all that stuff, and all you have to do is plug in some of your time and effort in cash, and then you're off and running, and you start creating this banking system. And I say system again because of the idea of multiple policies on yourself, multiple policies on other people in your insurable interest uh, collection, like obviously your children and your spouse and all that.
yeah,
And then, of course, you can go generational beyond that. But that's really what we're talking about is we're just plugging into a system that's already up and running,
Yeah,
and we just have to basically copy what they're doing, right? Which is, and he calls it code generation. Just plug into the system that's already running.
yeah.
And if if you
Being
had
Nelson,
extra, huh?
he being Nelson.
Yeah, Nelson. Yeah, sorry. Yeah. He's the big he for sure. Nelson Nash. Um, and with that said, I know we're going to go down a particular road, but and I've said this many times, but I'm going to read it from Becoming Your Own Banker. Um, on page 25 of the book, he says, would you have much of a grocery business, meaning grocery store business, if you were the only customer? You must build it to a point where you accommodate the needs of others in order to prosper. The same principle applies in banking. Furthermore, I'm not describing one life insurance policy. This is a system of policies. Have you not noticed that when a grocery store becomes successful in one location, then it tends to establish another store in another location? Have you not noticed that the banks have branch offices? There must be a reason for this behavior. So he just goes on about that. But um,
Yeah, and to just to go on with that, the whole idea about the franchise, well, we all know that there are franchise owners that own multiple McDonald's or Starbucks or whatever. They don't just, some of them own one, but many of them own more than one. So anyway, just
well,
thought I'd
yeah,
throw that in.
I know here in the Northeast, or at least where Dunkin' Donuts started, you end up hearing enough stories about people getting in early on that franchise. And when you buy a franchise, you're actually buying a territory. So there's a mapped out territory, and I think, expect you, or even it's required that you're going to have to open up multiple locations,
Oh,
right?
didn't know that.
Yeah, yeah, because they definitely own, say five or six or even more in a region,
Mm,
a small region, but yeah, maybe two or three towns. All of a sudden they're in gas stations, and they're in their own standalones, and
yeah.
they're everywhere. So yeah, I think in my town of less than 10,000 people, um, I think we had six Dunkin' Donuts there.
In the Hampstead?
Yeah, yeah,
Holy mackerel, really? In
yeah,
that little town?
yeah, yeah.
Wow,
And they all seem to be busy, you
unbelievable.
know?
I never
Yeah,
would
it
have
was
guessed that.
crazy. Yeah. Like I said, they were in some of these gas stations. They had their own standalones. They had a couple standalones. They had a couple gas stations. Yeah, they probably had, yeah, maybe more gas stations, maybe three gas stations. So there was at least five or six. So yeah,
Yeah.
I think it was six, but I haven't got my numbers straight right at the moment. Yeah, in a very small town. I mean, whichever direction you went, you could get to a Dunkin' Donuts. Wherever you got your gas, pretty much you could get a Dunkin' Donuts cup of coffee or croissant, as you said earlier. Um, so back to this discussion, it's more like we said, it's a thinking exercise. We know that people have desires, wants, needs, and if they don't have a pool of cash to use as collateral, so that they can get a loan for it, like you can with a policy,
Yeah.
with your cash value, then um, yeah, you go to traditional banks and you borrow from them. And so we started with the cost of a home, and it, at
Yeah.
least here in the Northeast, the greater Boston area, you're going to get pretty much a very average house at this point for 500,000. And if you put 20% down, You get a loan of 400,000. And that loan over 30 years, that's going to turn into like 832,000 or something like that at 6%, like just 6%, which that's the going rate now. It's maybe a little bit higher than that, maybe 6 3/8 or, 6 1/3 or whatever. But it's, let's just say 6%. I think it's 832,000.
Yeah. Well,
So
you've written
yeah,
some numbers down, haven't you?
yeah.
Do you want to
Well,
show
it's going to
them
do an
or
exercise here. Yeah, I'm going to show the one thing we don't always think about is, getting into the house, and if whether we're selling one house and we're going to carry um uh some of the return you got from, the equity that you got out of the house. So let's say you come away with a couple 100,000. Now you can maybe roll some of it or all of it into the next house.
this is if you had a previous home?
Yeah,
Yeah.
or if it's your first house and you've saved all the money, right? To get in and put the 20% down on a $500,000 house, we're talking about $100,000. And do we even think about what that's done? That we've given away that 100,000 to the seller of the house, and they do whatever they're going to do with the money. But that hundred's never going to work for you ever again. So I did a quick exercise just on the down payment. And I'm going to show that if I can get to the share button here fast enough.
Yeah. 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 And to think about these numbers, um, if you were going to use it as an example of a car or something, so you'd tether it down, but it would still
Yeah.
be pretty significant on a car. Um,
Well, yeah, I'm using 100,000. So if you wanted to divide these numbers by five for a $20,000 used car, or cut it in half, cut the numbers in half, it's all the same,
yeah.
right? The
Yep. The
the
principle
car's
is still
50,
the same.
yeah, the car's 50,000. Just take these numbers and cut them in half. But I think it's worth looking at. So I just took this 100,000 and said, what if I had 100,000 and I just leave that to be invested at 5% for 30 years, right?
Yeah.
And so I had a future value of what that was going to be, 432,194, and then the total interest, of course, was 332. So at the end of the 30 years, I get my principal back, my 100,000 invested plus the 332. So now I got 432. But then I compared and I said, but while I leave my money and I can use it in a policy, I can leverage all this 100,000 to
Oh,
then,
this 100,000 is inside of a policy.
yeah,
And
let's say it's inside of a policy,
yeah.
and now I'm borrowing, using that 100 as collateral. Now I'm borrowing the 100,000 from the insurance company. Sorry, I'm moving this around a little bit. It's getting stuck. Um,
Yeah.
so then I looked at what my total payments, that's what the TP stands for. Well, my total payments to pay back that loan over 360 months, paying every month, is 212,173. My total interest, of course, was 112. So I said, well, while those two things were happening, one, I left my money to sit and grow and compound for 30 years. I borrowed the insurance company's money using mine as collateral. And so I said, well, my total value of the 100,000 invested is 432, less the total payment to pay it back. So my, you know, positive delta is 220,000. But I want to go back and say, well, if I made payments at 6% for 30 years, my payments would have to be 589.37, but $589 every month for 30 years, and then I would have paid off the loan. But I took the comparison and said, if I had invested the 100,000 or left it to compound, and I
Yeah.
had 432 over those 30 years, so I divided by 360 months, my actual, monthly return is $1,200 and 54 cents. But so I'm gonna end up with $1,200 every time I pay $589. So I'm making a payment every month of 589 to pay back my loan. But because I was not touching my money, my own money, and it was compounding over those 30 years, over those 360 months, I averaged $1,200 in return.
Yeah.
So we talked earlier, and I'll just finish with this and let you ask some questions, is we were saying, what if you had some sort of like ATM machine that if you stood in front of it and you stuck $1 in and it kicked out two every time you did that? When would you like to get started doing that? And how much of it would you do? Eh, I might spend I might spend some time standing in front of that machine.
Yeah.
I might put in at least a couple hours of work a day, you
Yeah, yeah,
know.
yeah, yeah.
So
Hey,
you'd be asking yourself, like, well, how many machines can I have like this,
yeah,
right?
yeah,
Can I get a like a whole vending machine route of these machines?
yeah, yeah,
And can I clone myself? And of course we can't do all that, but can we capitalize these systems so that we do what he says, is that we build this banking system to accommodate others? You know,
yeah, yeah.
we're,
Like you
we're basically we're
yeah,
accommodating others,
yeah,
and we'd have the ability to do more and more and more of this, the more we're capitalized.
yeah. And that's also why he would say, don't be afraid to capitalize. And lots of people, even I say it, we're all parroting things that we've learned over our lifetime, and that's one of them. Then don't be
Yeah,
afraid to capitalize, because it's all going to come back to you. Like the scenario of, we've heard this before, where you walk up to the bank teller and you say, hey, I'd like to take out some money here. Um, how much can I take out? And the teller says, well, how much did you put in? That's
yeah.
that
I mean,
that's the scenario.
It's so simple. It's
Yeah.
it's almost missed, right? And that's why we
Yeah.
repeat these things over and over, and these kinds of
Yeah. And a lot of times
podcasts and
they're
discussions.
so they're so it's, this is our New England interruption machine. But they're so simple that we don't really think about how powerful they are. But
Yeah. Oh
it's
yeah.
really very simple. Um, the question I got to ask you, do you have the future calculator still up on your computer there? Do you
I
have it?
don't, but I can pull it up. It's easy
Yeah,
enough.
and then share it. And one of the things I'd like to just mention is, I think it's great that you're saying 5%, that the insurance company the thing would be growing at 5% within the policy. But I think that's probably for somebody that starts really young, like 18, uh, and sticks with it. But I would venture to say, plug in, if you could plug in, what is even 3.5%, which is about somebody my age and probably yours as well, but that that and then people in their 40s and 50s, it's probably somewhere around 4%, maybe a little bit more. But what are those numbers? And here's the calculator.net. Anybody can go to this. It's free. You can and there's all kinds of, over here to the right, you can see that little table that says financial calculators, all the different calculators. This is not quite as robust as truth concepts calculators, but it does the job. But if you put in that 100,000, what does that come out to? Hit the calculator. Yeah, it's 200, still 280.
Yeah.
And what was the other number on the 6% you're paying?
Yeah, so
Oh, does it?
it grow to 423. So
Yeah,
if I just plug in, you can just see it really quick. Oh, sorry. That was too much. I put it was 5%, we said, right? So
that is the
432, not
432.
423.
Yeah.
Yeah.
And then if you
So
drop
yeah,
3.5, then you go to 3.5, and what does it do? 3.55, 280.
so 280.
So
So
still,
that's a significant difference. I mean, it is
yeah,
153,000, but yeah, you're still doing 280.
yep,
So as I was saying, uh, your cost was 212. So you're still making 68,000 or so, a little more than 68,000. So
right.
it's not the same, but even so, 68,000,
Well, I want to
I
say
have to,
it's 68,000 or 3.5% for somebody my age starting a policy, and
yep,
getting 100,000 in there. And what happens? Okay, so you might say, well, you're not going to live another 30 years. You're 68 years old. There's a big chance that I will live another 30 years. Um, and it could all come to me, and I'm not doing anything. This is really passive income, is what you're looking at. This is what also makes whole life dividend paying insurance an asset, the and asset with Caleb writing that book. It's an asset. Uh, yeah. And so, yeah, I just wanted to show that. And what about 4%? If you just bump it up
yeah,
0.5%, what does that do?
yeah,
Which a lot of people would say probably nothing. Well, if you look over 30 years, because time is that powerful ingredient to creating wealth. That's really how wealth happens, right?
yeah,
Over time. It doesn't, well, you could win the lottery. Yeah. But boy, you
yeah,
gotta know what to do with the money when you win the lottery, or it'll all
yeah.
go straight. So
I'd have to do the exact numbers, and I'm not going to go grab a calculator at this point, but I would venture to say, just like the other scenario I showed where you're paying 589 a month, but you're kicking out 1,200 on average.
yeah,
So you're more than doubling. It's like, yeah, let's just say we all know it's more than doubling
yeah,
the return. So every dollar you put in, you're getting two or more. In this case, with 68,000, and it cost you 212 basically. Um, your return is 32%, right? So it's still,
still pretty
going to be,
robust.
yeah, it's still going to be a good return every month,
Yeah.
to do that.
Can you
If
show
you
us
could
what?
get 32% on your money every time you put it in the machine, right? It kicked out $1.32, you do it, right?
Yeah, yeah. What does 4% look like?
Yeah. So,
It's phenomenal. It's
yeah.
it's crazy. And again, that time element is what it really is. Um,
And I think it's the fact that the reason we call this a thinking exercise is because we're just trying to say, think about it. I didn't think about it when I was taking my 20% back in 1994 and put it down on a house, right? What would that 20% be worth? It was 25,000 on a $125,000 house. I could do that. I could say,
yeah,
because it's exactly 30 years ago, this past March, that I took out that mortgage. And, if I had said 25,000, And even 4%, it'd be
Yeah,
worth $81,000 right now. And this is the thing, Ray, is that we want to be very clear, is that we're not talking about like sticking your money away where you can't use it,
right,
right? Like we're talking about that you could be leveraging the growth of this money, even when you're collateralizing your cash value to take a loan, your money's still growing. So there's more and more equity that just can't be taken away from you in some market volatility, right? It's permanent. And you keep depositing new cash flow into your banking system through your annual premiums, right?
right.
Your insurance premiums. You keep adding to the pile. And all that time, over 30 years, you keep getting to leverage it. So
Yeah,
when you paid back to that example of the 589 every month for $100,000 loan at 6%,
yeah,
you had access to that 589 almost immediately. Again, you
yep,
could use it again.
yes,
And every month thereafter, every time you put the 589 in, you get to use the 589 again.
yep, yep,
It's dollar for dollar. That goes straight to your equity, you know?
yep,
It's and that's the thing that people would naturally have a hard time wrapping their heads around, maybe because that's not the way everything works, right? I have to wait. If I'm investing my money, most of the time I'm investing it for the long term. I'm thinking out, way out in the future, whether it be for a house someday. And now I take it off the table because I've saved and now I go and spend it. So now it's not
yeah,
compounding anymore.
yeah,
And we're talking about something totally different here. It's a totally different animal,
yeah. It's a
as they
totally
say.
different product, tool, however you want to phrase it, but yeah, animal. The other thing is that it not only stops compounding, but any gain that you gather, you're going to get taxed on. If you
Oh,
take it out of the stock market and there's a gain, that's income to you, how they look at it,
yeah,
tax
it's a
wise.
capital gain.
So you're
It's a
going to get
capital gain.
taxed on it. Where when you do it inside the policy, that's not
Great
happening.
point.
So
Great
when you're,
point.
yeah, it's yeah, all it isn't how much you make. So you're in the stock market and you make so much. It isn't how much you make. It's how much you get to keep. That's really the bottom line.
Yeah.
So when you take a loan out of the policy and you collateralize against the death benefit, because the death benefit is the collateralization, that's why they don't ask you any questions about it. And then you make it, just even if you made it, I think I'm actually, well, I'm not actually thinking about it, but it popped into my head when I like to go look at old motorcycles. Not that I've ever owned one, but it's an original BMW that I wanted 20 years ago. More than that, actually, more like 30 or 40 years ago. And they came up with this particular color scheme with the GS model. I see one out on Cycle Trader, and it's $2,500, and it's only got 60,000 miles on it. I'm like, $2,500. That thing's worth at least 4 or 5. It's worth at least 4 or 5, because there's other ones out there that they don't even actually give you the price. You actually have to call for it, because it's a
Right, right, right,
price.
right,
It's
right.
not $2,500. So I'm thinking, well, geez, if I took a loan, bought the bike, turned right around and put it out there for sale for $5,000 and just say I got 4. That's quick,
Yeah.
easy money. So it's those kinds of things that you can do with having a pool of capital. Um, and
Yep.
there's only one
Yeah.
pool of capital. It's
Yeah.
floating around the earth every day looking for a home, and it just depends on how big of a part of that you want to be. And
Right.
granted, it does take time. It does take a little bit of time to get something in there that you can start with. But, you and I both have clients that plop 100,000 or more into these policies the first year, and the way they're designed, they
How
can
about
have
that?
access to, you know, 50, $60,000 of that immediately and go and make an investment. And
Yep.
all the while, that money is continuing to grow. Uh, I mean, it does start to grow immediately. In some ways, people say, "Well, I can see that I've lost some money there those first few years." Yeah, but it starts to pick up and it snowballs, and you get it all back and way more. Anyway, that's me rambling.
Well, yeah. And I think in terms back to this idea of the franchise, right? I mean, it costs you money to buy the franchise.
Yeah,
So you'd say, well, geez, I just lost, $200,000 to buy that franchise. And that's probably a pretty inexpensive one for some of them. And no, no, you put that 200,000 to work because you just plugged into the system. But
yeah,
if you did that with a policy, let's just, it's a big number for some, for
yeah,
most,
yeah,
put 200,000 in, hey, and you still have access to 100 of it. Let's say you could still leverage 100 of it. You don't leverage any of that when you're buying a franchise. You gave the 200,000 to the people that created the whole system,
yeah,
and that's theirs to do whatever they do with it. But they allowed you into the club, you know?
yeah,
And this is really all it takes to get into this club is to have some cash flow and to be in relatively good health, standard health, maybe even substandard, you can still get into the club.
yeah, yeah,
But it's not hard. It's not hard to get in. And what an amazing thing it can do for your financial life to get into that club. And how
yeah,
hey, and they franchise the clubs too, so you can have multiple
yeah,
clubs or branches,
yeah, yeah,
right? I picked up the book, and that's why I'm coming off my view on the camera there. Is I was trying to come up with it quick enough because Brian Bloom, in one of his Confessions of a CPA book, says, would you rather have, like, I think it was like 500, I mean, sorry, $5 million that, then is going to be taxed, or would you rather have 3 million that's not going to be taxed? And he shows that, and I think, well, maybe it was a little bit more than three, but it was in the threes. Might have been 3.5, but let's just say it was three. That the three actually, it actually kicked out more cash than the 5 million.
yeah.
And it's
After the taxes and all that.
after the taxes and everything and all the costs, there's, yeah. So like you were saying, it's not just what you make, it's what you keep. It's not just what you save, it's what you can utilize. And how much can you utilize? And if somebody's taken, 40 of your 5 million, 40%, sorry, you know,
Yeah,
well, right there, you're down to three, you know.
yep,
So you didn't have use of the five, but maybe when you have three and now you can spend it tax free, again, maybe it was a little bit more than that. He just showed which
yeah,
would you rather have? Well, I want the one that I'm going to be able to utilize the money more.
right. Yeah, just keeps kicking it out. This is what makes it an asset, is its passive income. You know, um, it can take you up the hill, and you can ride it down. And it's not the only place you can do these things, but certainly it's a favorable place to be doing it. So anyway,
I honestly, um it's the only one where I have total control over whether I can utilize the money or not. There's
yeah,
so many other assets. I've got to go to somebody else to sort of unshackle the asset to let me get the money out. So I have to go to, I might have a whole bunch of real estate in my portfolio. But the only way I can get that money out is either to sell or to, get a loan based off of that equity
Yeah,
position I have in the real estate.
yeah,
If I have the equity position that I helped create with the insurance company, with this cogeneration plant, I have total control of whether I go and access that equity, that asset. And I don't think I can't think of another one like it, you know, where I'm gonna still let mine sit there and I can guarantee I can go get my equity. There's no questions asked. There's nobody saying, hey, let me look at the books, let me look at your P&Ls, let me look at your income statements. I need all this documentation. I see that you've got all this real estate, but I need to know that you're going to be able to pay this back if I give you, because they don't want to end up with your real estate. I don't really, well,
yeah,
maybe they do, but I've
yeah.
always believed they don't, the
Yeah,
banks
they're
don't
not
really
into
want to
real
own.
estate. I mean, in a
No,
sense,
they
they
don't.
are, because they might buy a building in town to have a bank.
Yeah.
In the
Yeah. They want their return of capital. They don't,
yeah,
they
they
don't
want to
want,
know if you can pay them back.
yeah, the
That-
cash,
Yeah,
not with the house.
that's what they want. Yeah. Um,
Exactly.
well, I'm good. I don't know if there's anything else you want to say about this.
No, I
I
think that
I think that's,
it's a good way to, yeah, just think.
yeah, a good wrap. So I want to say, please share, please subscribe, ding the bell, and if ever you want either John or I or both to speak to a group that you're part of, or anything like that, we'd be happy. We'll speak to one or speak to 10,000, whatever you'd like.
Absolutely.
So let us
Yeah.
know if that's something you'd
Yeah.
be interested in
Let's get
talking.
this road show started.
Yeah.
Yeah.
All
That
righty.
would be fun. That'd be a heck of a time. So let's do it. Anybody that wants to have some
All righty.
fun and think about it. All right. Thanks, Ray.
Thank you, Johnny. Catch
All
you
right.
next.
Yep. Thanks for